really focusing in on some of the large caps for reporting season. So, are you sitting there as investors thinking, where do you put your money? Do you side with the strength of iron ore, or do you go to some of the beaten up other, smaller or energy type names? They're the sorts of questions we're going to be trying to answer this morning. So we've had a look at the quarterlies. BHP and Rio certainly outperforming where it counts. Strong shipments in iron ore, where prices are also still outperforming what consensus has been predicting for almost a seventh year straight, which is pretty remarkable. So we were the top of consensus for iron ore prices going back about 3 months, but now we've fallen back to the middle of the pack with the whole market trying to play catch up to the strength that's been unfolding. So I think that'll very much be the key focus for both Rio and BHP in this results season. When I look at BHP, it's certainly hard to put any sort of positive buy recommendation on the stock, but that's not to say it shouldn't be a core holding in your portfolio and well worth taking notice of what sort of results they're putting out in the first half, due on the 20th. We're thinking that EBITDA will be a touch under 14 billion, almost 7 billion of NPAT. That's up year on year, and really driven by the strength of their cost performance and productivity across the Pilbara. Really, my view is that they will let their dividend payout ratio ease back from previous levels. They almost had a 70% payout of EPS a year ago. I think that'll be more like mid to high 50% sort of range. But again, the higher earnings is really dragging up where that dividend will end up anyway. So still supporting a fully franked dividend of 6% plus, which is really what we want to see from a big cap miner, and safe source of dividend yield for your clients. So I get a lot of questions week to week, given the high volatility in BHP's share price on what to do. I think at the moment it is in a genuine hold territory. If it does nudge above $50, I do think it is a trim candidate, even pre-results, because at that point, so much is factored in for the valuation that it would trump the dividend that we think would be about US 75 cents for the first half. Really, I wouldn't be chasing it up at these levels. It's really not for me back in value territory until it's below $43. For Rio, my view is a little bit more strained. I think that, it has a larger exposure in its earnings to iron ore, which is a key strength. That's a little bit dragged on by the high proportion of low-grade product it's producing at the moment. But equally, the discounts on that low-grade material are at near an all-time low. So it is getting a strong price for its iron ore products that's pushing into the market. But that's more than reflected in the current share price. I think that near $133, it's very hard to get as excited about the productivity program they're pushing across the rest of their assets, which I think now looks a bit priced in. So a bit bigger gap to where I see value. I think that in the result, a lot of the focus will be on iron ore, but I'm really interested to see how their alloy business is going in terms of costs. That's usually a weak spot for the company. Or area of risk in a result. I don't think it will affect the share price, but I am looking to see if where the valuation's pushed to is justified by the turnaround that they've been promising for alloy and copper. So, a bit of maybe a lackluster call to action on BHP and Rio, but I think they're important anchors to your clients' portfolios, and you can then pivot into some of the more beaten up names that I'll get to next. Yep, great. So, where I do have conviction and thump the table, very excited to have a buy rating again, is on Woodside. You look at the disconnect with the Santos share price, and to me, nearly all of that is attributed to the current merger talks between the two companies. I think that this results season, while it might be lower in EBITDA and NPAT terms for both companies, we're expecting for Woodside 23% lower year-on-year EBITDA and for Santos 20%. There's still extraordinary amounts of operating cash flow supporting both companies through their peak capex cycles. Now, before the announcement of possible merger talks, they were trading more in line, and I was tempted to upgrade both to a buy. But the market has quickly moved to assume that Santos is the beneficiary of the merger talks from a valuation standpoint, while also putting in some additional premium for corporate appeal from other potential suitors that might be out there. I'm not willing to pay for that kind of assumption up front. I think that Woodside, once the two are merged, if they do merge, would be the massive beneficiary of its upgraded fundamentals as a bigger, pure upstream top 10 global oil and gas producer. I think that it'd be an amazing position and would solve its long-term fundamental issue of Pluto and Northwest Shelf being maturing and entering a decline phase over the next three to 5 years. So with all of that said, I think Woodside trading back at near 31, 32 sort of levels. We've had the positive news on Scarborough, so that's a big weight off its shoulders. The market hopefully will start to gain some confidence in the oil price. It's got a smaller exposure to spot LNG, and I think it's a thumping good buy. Where for Santos, a lot of the similar themes, they've gotten past their issues at Scarborough, perhaps. They're backlaying pipeline at the moment. They had a reasonably moderate blowout in budget, but certainly wasn't too ugly considering what it could have been. And so I think they've done a good job to contain the cost there. But to me, it's all reflected in the current price. So when I look at the lithium space, which you would have seen, I just published a sector note last night. Certainly whopping big downgrades to our lithium forecasts. There was a bit of a gap from when Max departed to when I could refresh our assumptions. And in that time, lithium prices have completely collapsed across spodumene and chemicals. So, refreshing our assumptions, it is quite meaningful downgrades, but unfortunately, that does mask some of the positives that have been happening at both Mineral Resources and Pilbara. So for Mineral Resources, adding in Bald Hill, which is a lithium mine acquisition already producing, definitely value accretive. They also, in that recent quarterly, put out pretty staggering pace of cost reduction across their lithium mines at Mount Marion and Wodgina. So really applying some of that to our longer-term assumptions, adding in Bald Hill, rolling forward our model, which brings their material growth closer, is enough to offset the majority of a pretty staggering sort of EBITDA reduction in our forecast. But Pilbara Minerals, bit of a different story where really just using a company-wide review of assumptions that in Max's model that I've inherited, I'm a bit more optimistic on costs. I think that they've got the balance sheet to support. They've got two different phases of growth coming for their big, beautiful lithium mine. I think that will deliver material economies of scale that weren't in our assumptions, and that has actually offset more than the decrease, despite their larger sensitivity to lithium than what we saw in Mineral Resources. So for both of them, I think they're good buys. Certainly in that deep beaten up value territory. Mineral Resources is certainly much safer because they have that material growth in mining services and iron ore. I just keep going back to on June 1, they'll be commissioning their Ashburton mine in the Pilbara, which will essentially overnight triple their scale in iron ore or halving their cost base. So that'll become really meaningful. But even without that, just looking at those limited discounts in low-grade iron ore and a pretty good first half performance operationally, I think that their EBITDA for this half will double in iron ore, which certainly helps to cushion some of that reduction we've seen in lithium prices. So they're probably my key picks. The one I haven't gone through is South 32. I think that this will be a bit of a non-catalyst, which is why it's not up on the screen. But again, it's in that value territory. So if I'm ranking my coverage, it'd be Woodside number one as an absolute thumping buy opportunity. South 32 would be number two. For its collection of well-diversified assets that are probably most of them hitting a bottom at the moment, and then Mineral Resources number three. So with that, I'll hand over to Tom to run through the coals and the coppers.
Yeah, thanks, AP. G'day, everyone. Just really quickly on the biggest stocks under my coverage that will be relevant in reporting season, predominantly the cash flow producing coal names. So you would have noticed that we downgraded Whitehaven to a hold for the first time in several years a couple of weeks ago at its quarterly. The stock's not expensive. It's just trading at a much slimmer discount to valuation than it has done for a very long time. The same goes for Stanmore. Certainly New Hope has been a touch expensive for the last 6 months, and then Coronado's the cheap one, but it's cheap for a reason. So on the screen there, I've got just price to NPV multiples of that coverage on consensus numbers. My numbers aren't too far adrift from that, but the idea is here that what current price strength in this segment isn't recognising, I think, is some pretty tepid fundamentals in physical markets. So on the right-hand side of the chart there, I've just shown you the record discounts at which low-rank met coals are trading at relative to premium. I won't go into the details, but essentially, yes, index prices are pretty solid, but you look beneath that, scratch below the surface, and underlying steel demand is quite fickle. And there's some issues in the supply side. There's actually some pretty good supply out of Australia and also out of Russia. And these equities are just running on seasonality and not recognising those fundamentals. So they're looking a little bit stretched at the moment. We've talked about being nimble in this space a lot of times. As I said, Whitehaven's on a hold. Be happy to trim that and come back at a later date. Stanmore would have gone to a hold had it not corrected on its quarterly. Upcoming results, I think both those names could probably slightly disappoint on dividends at the February results period. New Hope, I think, has been a little expensive for a while, so the same applies there. I think we can all just wait for a better opportunity born out of probably some volatility in those physical markets. That's it. I'm conscious of time. I'll just hand over to Chris.
Gold stocks should be at least a part of your client's portfolio. It's not a big part, I suspect, for them. So really they ought to look at the larger companies. I've just got three there: Evolution Mining, Northern Star and Regis. Evolution suffered a significant fall in mid-January when they reported their December quarter production results with their Red Lake mine in Ontario underperforming. You can see that they're down 47% since their high. Northern Star's down 21%. It fell when there was a significant management change. MD retired. And Regis Resources, which is down 66%. There are all specific reasons for it. This is the Evolution slide, and you can see there the red line, the sharp decline when they reported their December quarter production results. This is the sort of numbers that they report in their quarterly. They tell you how many ounces they've produced. They tell you what the cash cost is. They tell you what the all-in sustaining cost is. They tell you what the capital cost is. So really it's a function then of what their other costs are, so that I don't believe there'll be any surprises for any of those three companies with their half-yearly results or yearly results. My expectation is that if you want to buy, you should be looking at Evolution in this market. Regis is the big decliner. It's a function of it had some management issues in 2020. It's got over those. It's got a McPhillamys development in New South Wales, which has been held up by the Environmental Defender's Office. They think they're through that, but that may or may not be the case. So Evolution, if you want to buy gold today, it's a small stock, but it's my favourite junior resources. Catalyst was a successful gold explorer in Victoria. And in fact, Gina Reinhardt and Hancock went in at $1.75 a share. You can get them for 70 cents now. It moved into the production side with the acquisition of the Henty mine, which is very small, and I think everyone lost interest. But the acquisition of Plutonic in Western Australia has changed it. It will become a 150,000 ounce a year producer. You can see their costs are high. For the December quarter, they were 26,000 ounces from both mines, so about 100,000 ounces a year. But their costs $2,800 against the average sale price of 2,900 Aussie dollars an ounce. You can see the steady decline in the Catalyst share price despite the move in the gold price. So if you're looking for the big ones, I think it should be an Evolution. The other two are both good stories, and they're Regis and Northern Star are both good stories, but off their highs, Regis is probably the one with more upside, I think, at this stage. And for a junior producer, I strongly recommend Catalyst. And that's it from me.